Imagine amassing a net worth of over $100 billion, all through investing. That's the story of Warren Buffett, the Oracle of Omaha. Just picture that for a moment. A fortune that vast, built not through inheritance or some flashy tech startup, but by the careful, patient act of investing. A quaint notion in our fast-paced world, isn't it? Yet that's exactly what Warren Buffett, one of the world's most successful investors, managed to achieve. Buffett, a name synonymous with wealth and investment acumen, has a reputation that precedes him. He's not just a billionaire, he's an icon, a beacon of enduring financial wisdom in an ever-fluctuating market. His success is the stuff of legends, the kind that inspires books, movies, and yes, even YouTube videos like this one. So how did he do it? Let's delve into the principles that guided his investment journey. Buffett's first principle: investing is not a game of luck, but a game of skill. This fundamental belief underscores Warren Buffett's approach to investing. For Buffett, understanding a company and its business model is the cornerstone of making wise investment decisions. Buffett's mantra is simple: risk comes from not knowing what you're doing. It's a stark reminder that investing isn't akin to rolling the dice at a casino. Rather, it's about meticulous research, careful analysis, and a deep understanding of the business landscape. You see, Buffett doesn't just look at numbers on a balance sheet. He delves into the heart of a company, scrutinizing its leadership, competitive advantages, and growth potential. He believes in comprehending the intricacies of a business, its strengths, weaknesses, and the markets it operates in. Knowledge, not luck, is the investor's greatest asset, according to Buffett. So the next time you consider an investment, remember, it's not about chance, it's about understanding. Buffett's second principle: be a long-term holder, not a short-term trader. This principle is fundamental to Warren Buffett's investment strategy. Buffett is a firm believer in the power of long-term investments. He isn't interested in quick wins or short-term gains. Instead, he focuses on the bigger picture, investing in companies that he believes will stand the test of time. His famous quote, "Our favorite holding period is forever," is a testament to this belief. It's not just about making a quick buck for Buffett. It's about investing in a company's future, believing in its potential, and sticking with it through thick and thin. It's about having the patience and the foresight to hold on to stocks for the long haul, even when the going gets tough. This principle shows Buffett's commitment to his investments and his confidence in his decisions. Truly, a lesson for all who venture into the world of investing. Buffett's third principle: always maintain a margin of safety. This principle is the bedrock of Warren Buffett's investment strategy, and it's all about minimizing risk. But what exactly does it mean to have a margin of safety? Imagine you're a tightrope walker. The higher you are from the ground, the greater the risk if you lose your balance. But if you have a safety net beneath you, even if you do fall, you're protected. The same concept applies to investing. The margin of safety is essentially your financial safety net. Buffett firmly believes in buying stocks at a price below their intrinsic value. Intrinsic value is the estimated true worth of a company, taking into account all aspects such as assets, earnings, dividends, and growth potential. By purchasing a stock for less than this value, Buffett ensures he has a cushion, or a margin of safety, against any potential losses. Think of it like shopping for a bargain. If you see a quality product on sale, you'd probably snap it up, right? The same principle applies here. Buffett is always on the lookout for quality stocks that are undervalued by the market. But it's important to remember that determining a company's intrinsic value is not an exact science. It involves a lot of research and analysis, and even then, it's still an estimation. Buffett spends a considerable amount of time studying a company's financials and understanding its business model before he makes a move. This margin of safety principle is what allows Buffett to remain calm during market downturns. When you've bought a stock at a price below its intrinsic value, market fluctuations don't cause as much anxiety. You know you've got your safety net in place. In essence, the margin of safety is a buffer against uncertainty, a tool to protect against the unpredictable nature of the stock market. It's about being cautious, patient, and always prepared for the unexpected. And that's why Buffett's third principle is so crucial. With a margin of safety, you can weather the storm when the market gets rough. Buffett's fourth principle: buy quality stocks, not cheap stocks. This principle is all about discerning the intrinsic value of a company, rather than being swayed by a low price tag. Buffett's strategy is one of patience and diligence, investing in companies that exhibit strong fundamentals, long-term stability, and the potential for growth. He's often quoted as saying, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This quote encapsulates his approach perfectly. He values quality over quantity, favoring businesses that are well managed, have a competitive advantage, and are likely to generate consistent profits over time. Buffett's principle reminds us that investing isn't a bargain hunt. It's a strategic decision to become a part owner of a business. And like any business owner, you'd want to invest in a company that's more likely to succeed in the long run. Investing in quality companies can provide a higher return in the long run. Buffett's fifth principle: understand the power of compound interest. This is the magic that can turn small, consistent investments into colossal wealth over time. Let's break this down. Compound interest is the process by which an investment grows not only from the initial principal amount, but also from the interest that has been added to it. In other words, you earn interest on your interest. It's like a snowball rolling down a hill, picking up more snow and growing larger as it goes. Warren Buffett once said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." This statement underlines the importance he places on this principle. Consider this. If you were to invest $1,000 at a 10% annual interest rate, at the end of the first year, you'd have $1,100. But instead of taking that $100 out, you leave it in the investment. The next year, you'd earn interest on $1,100, not just the original $1,000. That's compound interest in action. But here's the key. Compound interest needs time to work its magic. The longer you leave your money invested, the more dramatic the compounding effect becomes. That's why Buffett started investing at such a young age and why he recommends that others do the same. Buffett's strategy isn't about getting rich quick. It's about growing wealth slowly and steadily, year after year, decade after decade. It's about understanding the power of compound interest and harnessing it to your advantage. And remember, this principle isn't just for the wealthy or the financial experts. It's for everyone. Whether you're investing a few hundred or a few million, the principle remains the same. Compound interest can significantly boost your wealth over time. So, if you take one thing away from Buffett's wisdom today, let it be this. Start investing early, keep investing consistently, and let the power of compound interest do the heavy lifting for you. Compound interest can work wonders for patient investors. So, these are the 5 principles that have guided Warren Buffett's successful investment journey. Let's take a moment to reflect on the wisdom we've gleaned today from the Oracle of Omaha himself. Firstly, we learned about Buffett's initial principle, reminding us that investing isn't just about making a quick buck. It's about understanding the businesses we invest in. It's about being confident in the intrinsic value of a company and its potential for growth. Secondly, we delved into the concept of long-term commitment. Buffett's approach isn't about short-term gains. Instead, it's about investing with a long-term perspective. It's about patience, resilience, and a steadfast belief in the companies you choose to invest in. Next, we explored the principle of the margin of safety. This principle emphasizes the importance of mitigating risk and investing in companies that are undervalued. It's about not just looking at the potential for profit, but also at the potential for loss. Fourthly, we discussed the principle of quality over quantity. Buffett's investment strategy isn't about diversifying for the sake of diversification. Rather, it's about investing in a few high-quality companies that you understand and believe in. Lastly, we uncovered the power of compounding. This principle is about understanding the magic of consistent growth over time. It's about realizing that small, consistent gains can accumulate into significant wealth over the long. These principles aren't just about investing. They're about life, about making informed decisions, about patience, about resilience, and about believing in the potential of what you invest your time, energy, and resources in. You found this video helpful? Do subscribe and click on the bell icon to get notified when we upload a new video. Remember, investing is a journey, not a destination. Happy investing. Be